Hey, welcome everyone. My name is John Ballinger. I'm here with Eli Davis and Benjamin Myers, and we are so excited to present to you the Aspire Development project that we're currently working on. It's the Pearl District project in Tulsa, Oklahoma. We are going to go through this webinar and just give you the high-level details of the project and let you see what we are looking at for phase one and a little sneak peek into phase two. And then you will be able to get any more information you need from our website. And then you also be able to see our investor documents on Syndication Pro, and we can give a link to that in the description after the podcast. All right, Benjamin, Eli, you guys ready? We're gonna kick this off.
Yes, sir.
All right, so I am really excited, one, about this project. I'm really excited about my partners. We are kicking off 2023 with a really exciting opportunity in the heart of Tulsa, Oklahoma, just outside of downtown. But what I'm mostly excited about is my partners. Eli Davis, Benjamin Myers, myself. I think we've got a slam dunk partnership. We're really building off each other's strengths, finding the gaps that exist and exploiting those with everyone's experience in both development, property management, and the management and operations fields. So I'm going to talk real quick about Eli. He's a stud from Enid, Oklahoma, 14 years, experienced operator, multi-family property manager, basically in every state that touches Oklahoma. Almost 1,500 real estate transactions in the last 6 years. He owns a HOA company that manages 30 plus neighborhoods in Oklahoma and Texas. And he really just helps give a pulse on the market growth, the conditions, the direction, and current rates, as he's based out of Edmond, which is just an hour from Tulsa. So really excited about his expertise in the multifamily property management role, which will definitely be a huge asset as we get into the deeper parts of phase one, and especially into phase two, as we start development of larger multifamily project with the management on the backside. So really excited to have him as part of the team. Benjamin Myers, he has over 15 years of construction and development, been in the construction and development industry for a little over 15 years. On his own, he's done development projects ranging in size from $3 to $20 million. He was previously with Brailsford and Dunleavy. He worked in the project management and advisory capacity on projects that range from 40 to 140 million. He's been with Pulte Homes, managing infill multifamily development projects. And he's got his master's degree in real estate development from George Mason University. So heavy hitter, tons of knowledge, tons of experience in the development world, and a great asset to our team. And then I'm coming in, 20 years military background, finishing up with highly effective and successful teams. We're in a no-fail mission and doing that on a daily basis. We've got extensive backgrounds in operations, logistics, and facility management. And then I'm bringing to the team systems and management extensive approach with the knowledge of Tulsa and Oklahoma markets, as that's where I was born and raised and have family. So very knowledgeable of the area there. So we're also really excited about the partnerships that we have already established in the area. We have a great relationship already developing with Seltzer Schaefer Architects. They're just down the road on 6th Street, and they are an award-winning firm. They've done projects all throughout the city and all throughout Tulsa and Oklahoma City. They've got a great reputation, and they're working on other projects within the neighborhood. We're partnering up with Joel Coggins Construction. They're also based in Tulsa. They've got extensive experience in commercial construction, including a coffee shop right across the street from our development, and a breakfast restaurant just down the street called Bramble. They're very familiar with the buildings on this site, and they have extensive knowledge with the problems that we may encounter as we start phase one. And then thirdly, we've got Byron Elliott and his team at Three Pillars Law. They're based out of Colorado Springs, Colorado, and they're going to be helping us with all of our legal forms. They've got a bunch of products up on our Syndication Pro site. All the offerings, the PPM and the offering memorandum are going through Three Pillars Law and Byron. And he's got extensive experience with syndications, funds, tax structure, and tax credit developments. So great partnerships. And with that, I'm going to turn it over to Eli so he can talk about the area in Tulsa that we're focused on.
Thanks, John. I appreciate it. Appreciate you guys tuning in, taking a look at our project. What you'll see here is an overview. It'll zoom in just a second to the Pearl District project. So what we're looking at is an aerial view of that, and all of the spots in red come with the development deal that we have under contract. As you can see, the arrows, we have the University of Tulsa that's a mile in one direction, and then we have downtown Tulsa that's a couple of minute walk from the project currently. You can also see we have some yellow lines on this map that show other active developments that have been approved. You know, the Village Flats down here in the left-hand corner has already been built. It's actually where we get some of our commercial comps and our multifamily comp for the current area. The 555 Peoria development has not broken ground. And then the apartment renovations over here, there were some existing buildings that are currently being renovated at this time. We haven't been able, it's been fenced, so we haven't been able to walk through to see the level of renovation of those, but we do know that there's active work going on in that area right now. This is a view from basically from the University of Tulsa side, looking downtown Tulsa. What you see is the overview of Veterans Park. Just to the left of the park, you'll see some new apartments and townhome development. That is the Village Flats right there on the frontage road that has already been built. And then you'll see over to the left, we have a little lot that's on the other side of the street that we can use for overflow parking, some different things like that, but we have some plans for that down the road with this development. This is a street view looking at downtown Tulsa. At the end of the street is where the park begins. On the left-hand side, when you look at our pro forma numbers, we are basing our commercial pro forma numbers just on these three buildings that you see on the left, the red door, and then we have the yellow brick building that currently has a bar operating in that. And then the corner is where the restaurant previously was. On top of those two commercial spaces, there's 8 residential units. So when we talk about the immediate opportunities with this development for the phase 1 process, we will come in, we will renovate these commercial structures, commercial units, we'll do the exteriors and then white box out the commercial units. And we will get the residential units completely renovated and generating revenue. Our target is 6 to 8 months, so we should have revenue generated for the residential units. When you look down here and you see on the top, on the right-hand side, you'll see an 8-unit. That is also an 8-unit building. Is currently just a shell, has some framing, good floor stairwells, but we will renovate that. Speaking with the contractor, we'd be looking, that building will need full permits pulled. So we're looking at probably about 4 months from design and permitting process before we can start on those units. So our quickest units are the 8 units above the commercial space that we don't need permitting to go in and do the renovations on those. We just need to bring them up to current rentable levels, which we're going to do a high-end finish on those. We'll do them in a good spot so that we can get on the top end of the rental comps. Rental comps in this area are going anywhere from $1.50 to $2.50. We think we can land somewhere in the middle of that. Is where our projection is. Here's another view looking back down at the buildings. You'll see on the bottom corner here that used to be a restaurant. There's another commercial space that's about 1,500 square foot behind that in the back of the building. So all in all, we will have 4 commercial spaces that we can generate revenue off of that are rentable units as soon as we come in and do some renovations and what we call white box those out, get them ready for a tenant. It's a closer look at the 8-unit building. We'll do some exterior renovations. We're going to have to do some windows to make it meet code for residential. But the rest of the work is going to be on the inside. We've looked at adding some balconies and some areas where you can come out, sit, have your coffee, and have a beautiful view of downtown Tulsa.
So this is Benjamin here. Just wanted to take a look at some of the zoning considerations. So as you can see, most of the lots that we have fall within the CH zone. And the good thing about the CH zoning is it's very flexible. There's no height restriction. There's mixed use and multifamily are permitted by right, so you don't need to get a zoning change for that. And 100% lot coverage, all, like I said, resulting in very flexible site conditions. The RS4 piece of this equation, we will likely utilize for parking and support role for the phase 2 development, but also has fairly flexible zoning options if we wanted to utilize more of the site. Eli had brought this up, but just kind of looking at a snapshot of the market. So the current market rental range for 1-bedroom into 2-bedroom and varying sizes ranges around $1,450 to $2,000. And that roughly is $1.50 to $2.50 per square foot, depending on the size, the location, and the fit and finish. And as you can see, our proposed range is still within that same price target and runs about $2 a foot. So we're not trying to be too aggressive or too optimistic as the outcome is concerned. We're trying to put realistic perspective on the rental range that we believe we can get. And possibly those numbers could be greater, but we're not counting on it. So we're really looking at a 2-phased project, and all of the economics that we're presenting really revolves around phase 1. So if you only wanted to be involved in phase 1, it's okay. We can easily meet that objective. But the thing that we like about this is because there are multiple exit strategies, if you wanted to roll the equity creation and the initial equity into phase 2, it could continue to increase your yield, but you're not required to. If you wanted to be bought out or closed out of phase 1 after that's done, that works too. So we see phase 1 in 2 phases or 2 parts really. First part that Eli suggested really is a renovation of the existing building. So we're renovating some commercial space and we're renovating 16 multifamily units and adding some parking. Part of phase 2, or phase 1, I should say, part 2 of phase 1 is the design component for the second phase. So we're working with Seltzer Schaefer to design a mixed use building that encompasses 150 or greater than 150 units on the larger size and maybe just south of 150 on the smaller side. with ground floor retail. And some of the size considerations will be discussed and looked at from who the partners are and whether or not there's a likely participation in phase two, and two, what the risk profile would be for the partners that come into the deal. Phase two is basically the implementation of that plan that was a part of phase one. So this results in strong cash flow effectively for just the renovation of most of the buildings on the property, and an additional land-based equity increase with the plan that we could sell or we could keep or implement onto phase two. And obviously the phase two project just increases cash flow and balance sheet equity. So this is the nuts and bolts of what we're really looking for. We're looking for $3.5 million in exchange for 65% equity. What we're targeting and what we believe are realistic targets for phase one only is an 8% pref. So we're committing to an 8% pref starting in 12 months. So once we get the units cash flowing, we're looking at a 2x multiple and flexible exit strategies. And what we mean by flexible exit strategies is once we get cash flow, we could keep all of the cash flow, subdivide the new plan and sell off the new plan and just keep the cash flow so we can recoup our initial equity. We could sell off all of it, sell off a piece of it. We could roll the equity into phase two. There's a lot of different options that really make a lot of financial sense, which is what is most attractive in this deal for us. And it means that over the next 5-year horizon, if the investors that are participating in this deal have a change in their strategy, we can accommodate that change pretty comfortably. We're really excited about the opportunity for phase two, but we are being pretty focused on what phase one generates for us. So you can see here, we're projecting a 20% internal rate of return, which would obviously get better if we go into phase two, if that equity rolls. The timeline that we're getting to cash flow really is this 12 to 15 month renovation timeline, and that is to bring to market 16 new units and renovate or white box 4 commercial spaces with some additional, or some of those commercial spaces filled. We're looking at it from a timeline from a 5-year window. So we're expecting to give some or all of the investment back to the investors if the first phase one investors do not decide to roll into phase two. So you can expect these returns within a 5-year time, or at the end of a 5-year time horizon. This really is what it looks like from a sources and uses standpoint. So we have under agreement a $3.3 million purchase price. 1.3 million of that will be our down money, if you will, and which goes to the seller. The seller, because he doesn't have any leverage on the property, or won't once we give him the 1.3, will hold back a $2 million note, which is also really favorable in this context because it's a 5% interest rate, interest only for 2 years with a 1-year extension. So we have, in this market, we have cheap debt in place for a 3-year time horizon. What this really means, as far as what we would do with the $3.5 million that we raise, is we will, as you can see, cash to seller, we'll give 1.3 million to the seller. We'll take another 1.3 to improve the current buildings and to generate the 8% return and the 2x multiple. And then we'll leave some money aside to pay for soft costs and to use as contingency, depending on overruns or what else might pop up during the phase one time horizon. So on Syndication Pro, you'll be able to look at the nuts and bolts or the economics, the cash flow projections, and some of those details, but this is sticking to the high level. So we're really looking at a north of $500,000 a year in gross income. There's about 150,000 of expenses that includes management and maintenance. And we're looking at just south of $400,000 in NOI. So as you can see here, we have debt service accounted for to the seller. And then we have cash flow left over in at the 8% mark, which gets distributed to the investors. As you can see, it's an 8 pref there. And this is how we get to the balance sheet or the 2x multiple consideration. So once we spend $1.3 million to improve the current buildings, the cash flow from a cash flow basis, we'll be looking at a $6 million value. And that is based on a 6% cap rate. So we're not being overly aggressive on the cap rate that we could maybe get in the market. But we're just looking at what an NOI of $380,000 looks like. From a land-based perspective, obviously this number changes up or down depending on how many units you have. But if we were to sell a project that is designed and ready to be built, we're looking north of 150 units. We're looking at around $4.5 million of value. So that piece, again, if we chose not to move forward with phase 2, could be sold, and as a way of one of the exit strategies. But if the market is in a good place, or in a place that we believe it will be in the next couple of years, we'll be able to grow, use this as land-based equity in a larger development project. And so that's where you get the 6 million and the 4.5 million. You get to the $10.5 million of value. So seller still has a $2 million note, which is right here, which means that the deal equity, if you will, what is left in the deal for all the partners comes to $8.5 million, which is where you get your 2x multiple. So just a quick snapshot with 2 different options on for phase 2. We had Seltzer Schaefer look at the property with us and come up with 2 strategies that have some similar traits to them, but as a different density yield. The first project here is based on a smaller square footage and unit count perspective. And what this really shows is it limits the amount of structured parking that we need. There's a central lawn and amenity space that could be shared either by the commercial space, the bar and beer garden area. It could be a function space for the residents. It could be a lot of different things for dog walking, anything like this. And this kind of shows you in our mind how we would activate the spaces between the building and add real value to the residential components. As you can see, the smaller size is just north of 100 units in aggregate, 8 townhomes, 95 apartments, and 3 additional commercial spaces, which means that on the low side yield count, we might be at 120 to 130 units in total. This in the center, we're looking at how can we really promote community and add real value and possible additional revenue generation in the courtyard area. That's a central area that we're talking here. And we have been in discussion with an individual, and we'll be looking at others as well, that could act as a boutique grocer to kind of promote walkability and the ability for someone that once they get home from work, they can get their groceries, they can go get a beer, or they can get coffee, hang out with friends without needing to get back in the car. This is the sort of the perspective looking down 6th Street with Tulsa in the background. So again, this front part here would be a sort of boutique grocer sort of concept, setting the building back really helps kind of keep and promote the size and scale of the two-story buildings that are currently in place, and still allows us to get the density that we really want to get to. The second option was a little bit higher yield count, and the good thing about both of these is without much modification, we can increase or decrease the number of units. In this particular plan, there's additional cost in the parking capability, parking needs met. There's the larger area of structured parking or podium parking. We still tried to maintain a pocket cafe or a breezeway that allows us to have sort of some outdoor cafe, outdoor beer garden sort of perspective. And this will give you a sense of the size and scale, still keeping the renovating these two corner buildings. Still kind of setting back from the street like in the previous iteration. This one has a little bit better amenity package as it relates to a pool, an elevated pool. Still unbelievable views of downtown overlooking Veterans Park. So again, really like the size and scale, and we could add another level here, which gets us north of 200 units. I don't know if you caught that in the last one, but the way it's laid out now has roughly 160 multifamily units, 2 commercial and 5 townhouses. So in short, the thing that we're really excited about this project, really excited about the location. We like being in the center of where other economic activity is taking place, with the other developments that have happened or will be happening right around us. We really like that we're on the main thoroughfare for Route 6 with great views overlooking Veterans Park with the city skyline in the backdrop. Yeah, and a lot of flexible options as far as exit strategies. So I don't know if you want to sort of close us out, John, but we're really excited about this project and looking forward to bringing the right investors to kind of help share in the vision and or execution of this project.
Hey, I just want to say thanks, Benjamin. Thank you, Eli, for jumping on and doing this. You know, like Benjamin just said, we are super excited to partner with the right individuals, the right team to see this vision to fruition. And we are able to answer any questions you may have, or any concerns, or hear your thoughts. There's a couple ways to get a hold of us. Our office number is 619-300-5182. You can also find us at aspiredevgroup.com. That's ASPIREDEV group, GROP.com. And if you have any emails, questions you want to put in an email and send them to us, it's just aspiredevgroup@gmail.com. We'd love to hear your feedback. We'd love to hear your interest. If you do go to our website, it's currently under construction, but it's got a link there to our Syndication Pro site. You can jump on there, establish a login, password, and then you'll be able to see all of our operating agreements and our memorandums that we have available to you. Those should be available in the next couple days. So check that out as well. And let us know, again, if you have any questions. I am biased, but I'm extremely excited about our team, about being partnered with Eli and Benjamin and the experience they bring to the table, both in Tulsa and with construction and multifamily development. But I'm also excited just about the project and where it sits in Tulsa, being my hometown and the knowledge that I have about the town. Excited to see us really utilize this space in its max capacity. So please let us know if you have any questions. Thanks for your time, and we'll talk to you guys soon.
Thanks, everybody.